Welcome back to Jameel Cast, where we explore ideas and innovations shaping the future of our world. Join us as we uncover perspectives and insights at the intersection of purpose and progress, featuring voices from across Abdul Latif Jameel's international network of businesses. This is Alex, your AI host. Today we're exploring a contradiction at the heart of global development: water investment in emerging markets. The social case seems undeniable, yet private capital remains hesitant. And with me today is a new face on the Jameel Cast, our latest AI guest, Makoto, here to unpack this. Makoto, can you set the scene?
Certainly. The issue is a fundamental mismatch. The arguments for investment are strong. Clear links to improve public health, food security, and economic productivity. But when private capital assesses these projects using conventional risk-return models, the numbers often don't stack up. This imbalance, where financial returns don't appear to justify the perceived risks, has potentially been the driver behind decades of chronic underinvestment in a sector that's absolutely critical for resilience.
A classic mismatch. So is that dynamic finally starting to shift?
Yes, we're now seeing a definite shift, led by multilateral development banks. They're introducing new risk-sharing instruments and blended finance structures. It points towards a more structured and scalable approach to financing these essential projects, suggesting a new era of water finance might finally be within reach, which we'll explore today.
That new era sounds as if it could offer real promise. But let's back up for a second, because I think listeners will want the full picture of why this has been such a hard problem to crack in the first place.
Okay, well yes, it's a classic paradox. The social and economic returns are massive. You see it in improved health, enhanced productivity, and even gender equality. But when private investors use conventional risk-return models, the direct financial returns often appear insufficient to gamble. These models struggle to quantify the broad societal benefits into a neat financial number, so the projects look less attractive than they truly are. This has been the core obstacle for decades.
So the models are missing the full picture. What was the direct consequence of that measurement gap?
The primary consequence was decades of systemic underinvestment, leaving billions without safe water. And in many cases where money was invested, the projects didn't meet the expectations they were built on. This track record created a powerful perception of high risk for low returns, which has been a major barrier to attracting the catalytic private capital that is so desperately needed.
So given that powerful perception of risk you mentioned, Makoto, what did the big players do about it? How have traditional risk mitigation approaches shaped investment in the water sector?
The major development banks, like the World Bank and African Development Bank, evolved their thinking significantly. They moved past just direct lending to creating instruments like partial risk guarantees and political risk insurance. The idea wasn't to guarantee profits, but to guarantee stable rules of the game for private firms. They aimed to absorb the exact risks, like sudden regulatory shifts, that investors can't effectively price, which would hopefully lower the overall cost of capital.
Okay, so finding a way to provide a backstop against those non-commercial risks.
Yes, that's exactly right. But while these guarantees cover things like non-payment by a utility or even civil disturbance, they have practical limits. They can be extremely rigid and costly. Take MIGA, the Multilateral Investment Guarantee Agency, as an example. Some of its protections only pay out after a lengthy arbitration or dispute resolution process. That's simply too slow for situations where investors need certainty fast, which undercuts the tool's real-world value.
It almost begs the question, why are they so much more critical for water compared to sectors like energy or telecoms?
The rationale is strongest in water because the commercial case is inherently tougher. Unlike a power plant, water projects rarely generate immediate commercial returns. Tariffs are politically sensitive and revenue collection is often inconsistent, creating a mix of regulatory and payment risk for private investors. Even when long-term demand is secure, guarantees serve as a bridge connecting water's immense public value to a viable private investment case.
And I imagine the physical assets themselves play a role.
Yes, that's true also. A dam or, say, a pipeline is fixed. You can't relocate it if the political climate sours or a drought hits. There's no exit. This physical immobility makes political stability essential, not just desirable. So a multilateral guarantee provides more than just a financial backstop. It signals a level of international oversight that investors find genuinely reassuring for such a long-term, immovable commitment.
That point about reassurance for long-term commitments is key. How is the role of these guarantees actually evolving to meet modern investor needs?
We're seeing a shift from project-specific guarantees to portfolio approaches. Investors, especially institutional ones, don't want to bet on a single, potentially unstable territory. They'd rather commit to a managed global portfolio that spreads risk across different countries and asset classes. This model allows for broader participation and creates more stable, diversified returns.
That's the portfolio shift on the investor side. Is there a parallel shift happening on the ground in terms of who actually delivers these projects?
Yes, that's the other critical evolution. Historically, financing went directly to governments, who often lacked the in-house experience to manage complex infrastructure projects. Now, implementation is increasingly placed in the hands of specialized private companies who bring that expertise while the state retains ownership. The guarantee is what makes this viable. It covers risks the government can't take on itself, and without it, these companies wouldn't participate.
That's a fascinating evolution. It sounds like we need more than just guarantees. What role do local capital markets play in unlocking investment?
It's a crucial second dimension. A huge barrier in middle and low-income countries is currency risk. Project revenues are in the local currency, but debt is often denominated in dollars or euros. This mismatch creates significant exchange rate exposure for investors. So, the real evolution is linking guarantees with mechanisms that build and strengthen those local capital markets to directly address this problem.
So you're using financial tools to tackle that currency exposure head-on.
Precisely. Tools like currency hedging, local currency bonds, and synthetic instruments can reduce that exposure. But beyond just risk mitigation, these instruments deepen domestic financial markets. This creates a virtuous cycle of reinvestment and strengthens the country's long-term financial resilience, making it a more attractive environment for future projects.
That idea of a virtuous cycle is powerful. It seems like we can apply a similar logic to the guarantees themselves. How can those guarantees be aligned more closely with actual performance?
That's really the next evolution, aligning incentives with risk management. Multilateral development banks can expand what we call results-based guarantees. Under this model, the guarantee's coverage might be extended or funds dispersed, only when a utility meets pre-agreed performance criteria. Think specific, measurable targets like ensuring continuity of service, reducing non-revenue water, or connecting previously excluded marginalized communities.
I see. It's not just a passive backstop for risk. The guarantee itself becomes an active incentive.
Yes, that's correct. It transforms the guarantee into a lever for accountability. This approach ensures both public and private actors stay focused on service quality and long-term outcomes, not just on the initial capital expenditure. It powerfully reinforces a shift towards value creation for the communities being served.
That shift towards accountability is a crucial point. Before we even get to structuring guarantees, how do private companies initially assess risk in potential water investments? What are they looking for?
From a company's perspective, the core question is whether risks are predictable, allocable, and insurable. Before committing capital, they'll scrutinize three critical factors. First, the stability of the regulatory environment. Can they count on it for 15 to 20 years? Second, the management of currency risk. And third, the clarity of long-term demand and the sustainability of the water resource itself.
So, it's a long-term, holistic view, not just a financial calculation.
Exactly. Infrastructure built without solid hydrological projections could become a stranded asset within a decade. That's why companies now look for a complete risk management architecture. They aren't just looking for isolated financial instruments. They need an integrated system that combines financial guarantees with resource risk analytics and governance frameworks to feel secure.
It brings up a common criticism of guarantees, that they just socialize risk while privatizing profit. How should they be positioned within the broader model to be truly effective?
That concern has merit if guarantees are deployed without clear conditions. But when designed effectively, their purpose is to rebalance risk across all stakeholders. They essentially act as a catalyst, unlocking investment that would otherwise remain out of reach.
So now it's about rebalancing, not just a one-way transfer of risk.
Right. In middle and low-income countries, this mobilizes private capital, improves creditworthiness, and reduces borrowing costs. For multilateral development banks providing them, it's about leverage. They use their balance sheets to achieve a catalytic impact, rather than just substituting their own capital.
Okay, so if we're rebalancing risk rather than just transferring it, what needs to happen next to actually scale this globally?
The current evolution must continue, even accelerate if possible. To mobilize the trillions necessary to meet the ambitions of the United Nations Sustainable Development Goal 6, we need to scale up tools like portfolio-based guarantees and performance-linked finance. Crucially, these financial structures must align with the physical and governance realities of the water system. When risks are managed and incentives align, the private sector is ready. The key is using pragmatic instruments that enable sustainable services, not just de-risk a project on paper.
And what's the final barrier to making that happen, in your view?
Currently, I see that we're in a transition. Multilaterals are ready for this model, but they need a pipeline of projects from companies. The final step is coordination, getting multilaterals, companies, and governments moving in the same direction. That's the hurdle we have to clear, but we're seeing early movement in this direction in a handful of markets, though it's still early days.
So building on that point about coordination, what are the actual tools and frameworks that help get everyone moving together and enable this investment at scale?
The toolkit is expanding. We're seeing guarantees, blended finance, and capital market innovations all come together to give investors and governments more to work with. It's about building a bridge between government needs and private capital's requirements.
Then it's about aligning the financial engineering with the on-the-ground reality of the water systems themselves.
Right again. Risk-sharing frameworks and performance-linked structures are vital. As pressures on water systems intensify, the ability to structure risk effectively will play a defining role in unlocking capital. With these frameworks in place, investment can finally move beyond its long-standing constraints and begin to support the sustainable infrastructure we need to meet global needs.
So the big takeaway is that while risk remains the barrier, the tools to manage it are becoming much smarter. We're moving beyond simply insuring against political shifts. The new model uses guarantees as a catalyst to actively rebalance risk, align incentives with performance, and build local capital markets. It's a shift from a passive backstop to a proactive financial architecture designed to unlock private investment at scale.
I'd agree with that. And the final piece is coordination. The financial tools exist, but they need a pipeline of bankable projects. When governments, companies, and development banks align, that's when capital will truly flow.
Makoto, thank you for breaking down such a complex topic. And a huge thank you to our listeners for tuning in. For a full transcript of today's episode and to learn more about our work, please visit our website. We'll be back soon with another deep dive. You've been listening to Jameel Cast, the official podcast of Abdul Latif Jameel. For more insights and conversations shaping our future, follow us wherever you get your podcasts or visit alj.com to read our Perspectives articles. Thank you for joining us, and until next time, stay curious.